My name's Lloyd. I'm the Executive Director with Infrastructure Capital Group. We're an infrastructure fund manager that's been investing for over 20 years in Australia and New Zealand. We manage 3 open-ended infrastructure funds and a variety of separate accounts. Open-ended structures are favoured by investors that are looking for long-term investments to match long-dated liabilities, and these are typically pension funds. They're particularly relevant for investments in the core infrastructure assets, where the underlying asset is typically long-term in nature with stable, low volatility cash flow streams. An important feature of open-ended funds is they're not required to divest investments at any predetermined point in time, but rather they take a buy and hold approach and continue to own assets for long term, which matches the investment duration of infrastructure assets. The general investment strategy of open-ended funds is to maximise cash flows over the long term. This is different to closed-end funds that are focused on capital gains over the short to medium term. So that's why you'll typically see closed-end funds used in a private equity environment that are focused on creating value in the short term, and open-ended funds being more popular in the core infrastructure sector, where assets are more suited to longer-term investing. In addition to this, open-ended funds provide investors with significantly more transparency, given that investors are buying into a known and diversified pool of assets rather than simply handing a blind pool of capital to a GP. Australian investors have been using open-ended funds to invest into infrastructure assets for over 20 years. Canadian investors have also adopted this long-term buy and hold approach through their direct investment strategies, and that's also been going for well over 20 years. Whilst closed-end funds were the initial focus for investors in North America and Europe, who were approaching the asset class around a decade ago, we're now seeing an increasing appetite for open-ended funds from investors globally, particularly from longer-term investors such as the pension funds. This means we're seeing an increasing number of open-ended funds in the market, with several new global funds being raised in addition to the longer-standing regional-based funds. The regional funds have built hard-to-replicate portfolios in each of their regions over an extended period of time, and as I mentioned before, the nature of these funds with the existing portfolios means that investors can review and assess the quality of the portfolios before investing. Look, there are 2 main challenges with open-ended funds, pricing and secondly, liquidity. In terms of liquidity, open-ended funds, I think, typically provide more regular liquidity than a closed-end fund. The benefit from an open-ended structure is having this perpetual pool of assets, and so the challenge for GPs is balancing the regularity of liquidity that's provided to investors and that investors require against the relatively illiquid nature of the infrastructure assets, and trying to avoid the drag on returns that's caused by a regular turnover of assets. In terms of pricing, given the low turnover of assets, fund pricing is reliant on valuations rather than realised transactional outcomes that is commonly seen in closed-end funds. On liquidity, investors have the ability to achieve liquidity by selling units at any point in time, and there's an active market for secondary interests in existing funds. However, most funds also have a defined liquidity mechanism within a fund, which allows investors to apply for liquidity at regular intervals. This is a neat solution for GPs, as they are required to provide liquidity under this mechanism, but can do it over time as the investors require it, rather than requiring a wholesale divestment of the portfolio at a single point in time. In terms of pricing, open-ended funds undertake regular valuations conducted by an independent expert. This will use a consistent and set methodology to ensure there's consistency across time with those valuations. The valuer will also use market comparisons in addition to any bottom-up analysis to support their assessment of valuation. In summary, open-ended funds are particularly relevant for the core infrastructure sector, given the long-term nature of the underlying assets, and I think they provide a solution for investors seeking long-term investment in stable cash flow generating assets.